last quarter's vodcast, I remarked that the market environment had been challenging. Well, the past quarter, the final 3 months of 2018, brought with them an acceleration of negative sentiment in the equity market and, as a result, greater volatility. In the final quarter of 2018, sentiment well and truly turned from exuberance to despair. Markets started 2018 with a surge in January, but by the fourth quarter, the Goldilocks environment of 2017, not too hot, not too cold, was well and truly buried. 2018's carnage began in China and other emerging markets, followed by developed markets, especially those most exposed to global trade such as Germany, and eventually to the US, which held up well until a disastrous December when the S&P index fell by 9%, taking its return into negative territory for the year. Very few assets produced a positive return in the year, and many equity markets entered bear market territory with falls of 20% and more from the peak. As a result, there were precious few places to hide that would provide genuine diversification to returns over the quarter. Despite the difficulties, we see reasons for optimism looking through 2019, which I will address at the end of this film. Over the final quarter, the UK's 100 or so largest companies returned minus 9.7%. The more domestically orientated smaller companies fell by close to 16%. The gilt market and other fixed income markets provided a degree of mitigation to the worst of the equity market falls, with the gilt market increasing by 2% over the quarter. Against that backdrop, the unitised strategies returned between minus 2.3% for Focus 3 to minus 5.9% for Focus 5 over the past quarter. The UK advisor DFM managed portfolios returned between minus 2.0 and minus 6.5%. And while we target long-term returns in excess of inflation, these strategies invest in the markets and therefore cannot be totally immunised from the worst of the market moves. The portfolios demonstrated significant capital preservation qualities when compared to the UK equity market, and this comes from a variety of sources such as our fixed income allocations, especially government bonds, as well as our allocations outside of the UK, which benefited from a weakening pound, which provided a tailwind to their translated currency effects. Furthermore, our exposure to physical gold returned 10% as investors moved from traditional investments to the commodity. Despite more challenging performance in recent periods, over the longer time horizons, the portfolio's returns are still broadly on track of delivering their investment objectives. The recent market weakness means that they have slipped behind their longer term objectives somewhat, but they're within normal expectations for this stage in the cycle. Following the most difficult year and sharpest falls in the market since the financial crisis, risk aversion among investors is high and uncertainties abound. Yet markets have repriced these risks substantially in 2018. All major equity markets fell, yet corporate profits were strong, most notably in the US with growth of over 20%. And this means equity markets offer much more attractive valuations as we enter 2019. In fixed income, the drop in yields of safe haven government bonds in the market rout has reduced their attractiveness, but elsewhere credit spreads have widened substantially in recent months and now provide much improved yields. It's easy for the positives to be overlooked in tough market conditions. There are few, if any, signs of capacity shortages, overheating, or sharply rising inflation that would trigger sudden and unexpected tightening of policy and presage a recession. It would appear to us, then, that markets have discounted more of the risks than is warranted. The markets have deteriorated much more than the fundamentals. This presents a good opportunity to increase exposure to risk assets in portfolios, in equities, as well as both investment grade and high yield corporate bonds. Market moves in the past year have once again illustrated the benefits of diversification, and this will remain vital in the year ahead. We are constructive about risk assets after the falls and see no major deterioration from here in the fundamentals, and in fact anticipate some improvement relative to the market's current gloomy view. That doesn't amount to an unbridled bullish environment, however. We will therefore continue to build our portfolio with true diversification and resilience around a core in equities, making use of the wide range of asset classes which exhibit relatively low correlation with traditional assets, including infrastructure, selected property, gold, liquid alternatives where mandates permit, as well as safe haven bonds and as and when yields pick up from recent falls. With careful diversification and the conviction to look through the current gloom, 2019 promises to be much improved compared with 2018 and has the potential to deliver at least mid-single-digit returns, albeit with bumps along the way.